All right, y'all, we have a lot to cover this week. Today on Real Estate Backstage, the rate of home price growth continues to slow. The labor market is trending in a very positive direction. NAR membership levels fall below 1.5 million nationwide. The Supreme Court meets today to decide whether or not they will hear arguments from NAR and the DOJ. RealPage is back in the DOJ's crosshairs. And lastly, a bill was introduced into Congress that would remove the lifetime mortgage insurance requirement for FHA loans. Now, before we jump into today's episode, if you are watching this on YouTube or listening on Apple Podcasts or Spotify, go ahead and subscribe. That way you don't miss any future episodes. And if you want links to any of the articles that we're going to reference today, you can find the show notes at realestatebackstage.com/episode 13. All right, so we're going to start with the Case-Shiller Home Price Index, the rate of home price appreciation. So this is according to RIS Media. Quote, the latest S&P CoreLogic Case-Shiller Home Price Index showed prices still increasing, but the rate of that increase has continued to slow down month over month. In October 2024, because the Case-Shiller Index runs on a 2-month lag, home prices saw an annual increase of 3.6%. This comes off the previous index finding of a 3.9% increase in September, which at the time was described as the lowest annual gain since August of 2023, when the annual gain was 2.6%. That description has now been taken by October's 3.6% gain, which is the latest in a 7-month streak of home price gains slowing month over month. A slower rate of growth should not be taken to mean that home prices are coming down, though. The Case-Shiller National Index, which is a composite of single-family home price indices and the Federal Housing Finance Authority data, reached a new record high for the 17th consecutive time in October 2024. The current index level, which is 324.22, is 75.6% higher than the previous index peak in 2006. In a release responding to the Case-Shiller Index, Bright MLS chief economist Dr. Lisa Studevant noticed that prices have risen every month in 2024, even as mortgage rates have remained stubbornly high and as housing affordability has reached an all-time low. So I've got a couple charts here I want to show you guys. The first one here is the S&P Case-Shiller National Home Price Index. You can see the lifetime value of that index ever since it first got started back in the 80s. And this is from the Federal Reserve. And then the second graph here is the year-over-year percent change in the index level. So you can see back, during the crash, great financial crisis, we saw a pretty significant dip there where prices were trending downward. But ever since then, we've only dipped ever so slightly below the line just one time in the aftermath of COVID. But we are still above the line, which means prices are still going up. We're still in positive territory. But you can see that the rate of growth is slowing down. All right, so let's shift gears to the labor market. So this is according to the Wall Street Journal. Quote, the U.S. economy added 256,000 jobs last month, and the unemployment rate edged down, the Labor Department said Friday. December's gain in non-farm payrolls was well above the 155,000 jobs that economists had expected, according to a Wall Street Journal survey. The 4.1% unemployment rate was also better than the expected 4.2%. The results were the latest sign that the U.S. labor market has recovered from its mid-year stumble and may even be gaining steam. But Friday's job report also shuts the door on a rate cut at the Federal Reserve's next meeting, which is January 28th and 29th, and reduces the chance of a cut at its subsequent meeting in March. The bottom line is that the economy is in a good place. It's growing very strongly. The labor market is at full employment, said St. Louis Fed President Alberto Mussolem in an interview Thursday. Looking ahead, the pace of rate reductions has to be patient and careful and very dependent on the outlook. Stocks opened lower after the report was released, and the yield on 10-year Treasury bonds jumped to 4.79% from around 4.7%, unquote. So this was a stronger than expected jobs report here in December, which of course means that the economy is continuing to hum along, and the Federal Reserve is going to be much less likely to aggressively cut rates in 2025. That's why stocks opened lower. Yields on treasuries were going up. Mortgage rates are sure to go up on this news as well. Now, that's the overall economy, the overall labor market. Let's kind of hone in on one specific sector. So this is from Housing Wire. Quote, for mortgage rates to go lower, we need to focus on the labor market, which has been critical to every economic cycle in recent history, and particularly the labor market for residential construction and remodeling. The existing home sales market has been in a recession since June 16th of 2022 and hasn't experienced any significant growth in sales for some time. However, the labor market for those working in the existing home sales market isn't substantial enough to impact an economy. In contrast, housing construction plays a more pivotal role in economic cycles. As payroll growth slows and becomes more concentrated, this sector can cool off the economy enough to raise the unemployment rate above 4.3%, which is the Fed's comfort level. As shown in the chart below, housing construction and remodeling labor typically declines before any recession, and historically, the Fed tends to overlook this data line before the recession, unquote. All right, so I've got this graph here from the Federal Reserve that shows the number of jobs in this very specific sector of the labor market, residential building construction. So this includes the employees in new home construction, working for builders, but this also includes those contractors who are renovating existing homes. And if we look back at the last several recessionary cycles, we're going to ignore the most recent one in 2020. That was just an anomaly. COVID was kind of like a once-in-a-lifetime event. So we're going to look at the recessionary cycle in 1990, in 2001, and 2008. So in advance of the 1990 recession, there was about a 24-month period from when the number of jobs in the residential building construction sector peaked and began to decline, and when we entered into a recession. So 24 months runtime from when we started to see the downward trend in these jobs and when the recession started. Next, we have a 12-month gap in advance of the 2001 recession, and then there was an 18-month gap in 2008. And that's a pretty decent lead time of when we can see a downward trend begin in jobs in this sector of the labor market and when we enter into a recession. But if you look at the most recent numbers, you can see that construction jobs are continuing to trend upward. It looks like we have not yet hit the peak, but once we do and we start to see consistent downward trend, that tells us there's a pretty good chance that we're about a year or two away from a recession. All right, shifting gears, let's talk about NAR membership levels. So this is according to Real Estate News. Quote, the latest membership counts are in, and they show that the National Association of Realtors lost 25,336 members during the month of December. It's the biggest monthly decline in nearly a year, following modest drops in October and November, bringing NAR's current total membership to 1.498 million, the lowest figure since last March. Despite its turbulent year, NAR's member base remained fairly stable throughout the second half of 2024, hovering around 1.52 million from June to December. After dropping below the 1.5 million mark early in the spring, the organization witnessed small but steady gains in membership ahead of the August deadline to implement new industry practice changes. Agents may have opted to join or renew their membership during that time to shield themselves from the risk of further lawsuits, some industry insiders suggested. While December's loss of more than 25,000 realtors is notable, it represents a decline of just 1.7% from November. And big drops around the turn of the year are not uncommon for NAR. The organization reported a dip of more than 17,000 members at this time last year and lost another 38,700 members in January of 2024. Unlike last year, however, NAR is seeing more threats from within. That could cause membership to drop further, especially if more local associations follow the lead of the Phoenix Realtors, which unveiled its new MLS Choice offering back in November. We've talked about this on several previous episodes of the show. That is a discounted membership level that includes access to MLS data and forms without joining a realtor association. Many MLS and association leaders are already anticipating reductions in member counts. A recent T360 survey of over 200 real estate association and MLS executives found that more than 70% are budgeting for a projected decrease in membership, citing a combination of external and internal factors. However, survey respondents don't see any major losses in the year. 65% anticipate membership declines in the 1 to 10% range, while just over 7% expect losses of 11 to 20%. So the majority of MLS associations across the country are expecting a continued decline in membership levels. However, they don't expect the declines to be that significant. So you may see this headline, NAR dips below 1.5 million, or over 25,000 people left the National Association of Realtors in December. However, again, that's less than a 2% drop in the member count. And there is typically a reduction in the wintertime. As we enter into a new year, people maybe don't have the money to renew their dues. Keep in mind, I think it's about 70% of realtors had either 0 or 1 closed transactions in 2024. So there are a lot of part-time agents, a lot of dual career agents, a lot of agents struggling in the industry right now who are not really doing transactions. So for them, maybe they would like to renew their membership, but they unfortunately just don't have the funds to do so. So I wouldn't read too much into it, but we will certainly keep an eye on membership levels and see if that trend continues. All right. So in that same vein, this is a recent survey from RIS Media. 44% of brokers are reconsidering NAR membership. So according to RIS Media, quote, facing an array of controversies, challenges, scandals, and legal troubles on multiple fronts, the National Association of Realtors is entering 2025 with a lot of work to do. That's for sure. As policy changes shook up the basic structure of real estate and pressure ramped up on other foundational industry practices, brokers look to NAR more than ever in 2024 for leadership, guidance, education, and representation. How did the Realtor Advocacy Organization meet this moment? Leading brokers polled as part of RIS Media's Broker Confidence Index were decidedly mixed in their assessment, saying that NAR struggled to effectively address urgent issues, even as many still recognized its essential role in advocacy in these turbulent times. Along with the many, many lawsuits, NAR also dealt with multiple internal controversies in 2024, including 2 New York Times exposés focused on political and personal spending. While many brokers qualitatively focused on the lawsuits as the reasons for dissatisfaction, those revelations clearly had an impact on how real estate professionals viewed NAR, with 42% of respondents referencing recent investigative reports as affecting their feelings about NAR. Brokers were also asked specifically if they were reconsidering their NAR membership in the new year due to recent events or revelations about the organization and to explain their decision-making. Slightly less than half, 44%, said explicitly that they were reconsidering, while even those who reiterated support for NAR expressed concerns. Asked to rate NAR's effectiveness in 8 different areas as a performance review, brokers graded the organization harshly on MLS issues, legal defense, and representing the brand, while offering somewhat higher marks on the longer-term mission of advocacy, training, and equity, unquote. All right, so today, the day that I'm recording this, which is Friday, January 10th, the Supreme Court is going to meet to decide whether or not to hear arguments in this ongoing case between NAR and the DOJ. So according to Inman, quote, the justices of the U.S. Supreme Court will convene on Friday to decide whether or not to weigh in on the National Association of Realtors case against the Department of Justice. According to the case's docket, on January 10th, the justices will gather together in a private conference to review NAR's petition, filed in October, asking the court to review an April ruling by the U.S. Court of Appeals for the District of Columbia Circuit, allowing the DOJ to reopen an investigation which it had previously closed into NAR's rules. These include controversial rules around commissions and pocket listings at issue in multiple antitrust suits against NAR, known as the participation rule and the clear cooperation policy. While NAR has gotten rid of the participation rule as part of a nationwide settlement of antitrust claims, the CCP is currently being hotly debated in the real estate industry, due in part to the DOJ's scrutiny. NAR's petition is a long shot. According to the federal government, 4 of the 9 justices on the Supreme Court must vote to accept a case, and the court only accepts a tiny percentage of the cases that it's asked to review each year, typically 100 to 150 cases out of more than 7,000 cases submitted. The court usually only agrees to hear a case if it could have national significance, might harmonize conflicting decisions in the federal circuit courts, and or could have precedential value. According to the court's website, the court will post its decision on whether to hear NAR's case at 9:30 a.m. Eastern on Monday, January 13th. So I'm recording this on Friday. By the time this comes out on Monday, they will have posted their decision. All right, so speaking of the DOJ, a few weeks ago on episode 9 of the show, we covered an announcement from RealPage that the DOJ had decided to withdraw its investigation into them and their algorithmic pricing models. However, according to Real Estate News earlier this week, quote, just a month after the company announced an investigation into its rental pricing practices had ended, the DOJ is back with an updated, expanded lawsuit. The agency, joined by several state co-plaintiffs, filed an amended complaint on January 7th in its antitrust case against RealPage, adding some of the largest multifamily companies in the U.S. to the lawsuit. Greystar, LivCore, Camden, Cushman, Willowbridge, and Cortland, which operate more than 1.3 million units in 43 states and the District of Columbia, according to a news release from the DOJ. The firms use RealPage's pricing algorithms, which the agency considers to be anti-competitive, and participated in an unlawful scheme to decrease competition among landlords in apartment pricing, harming millions of American renters, the release stated. In addition to the new defendants, attorneys general from 2 more states, Illinois and Massachusetts, have joined the group of plaintiffs. In response to the amended filing, the company said it is, quote, disappointed that the DOJ, just 1 month after abandoning its baseless criminal investigation and less than 2 weeks before the agency changes hands, since we're transitioning from the Biden administration to the Trump administration, is expanding its civil lawsuit related to the use of revenue management software. Fewer than 10% of all rental housing units in the U.S. use RealPage software to suggest rental prices, and our software recommendations are accepted less than half the time, as the DOJ has acknowledged, unquote. This DOJ certainly seems bent on getting as much enforcement action initiated as possible before the administration changes hands. All right, so there was a bill recently introduced to Congress that I'm kind of excited about, and you guys definitely need to be aware of. This would remove the requirement that mortgage insurance be permanent for the life of the loan for FHA borrowers. So this is according to Housing Wire. Quote, cutting the life of loan policy, which requires most FHA borrowers to maintain mortgage insurance throughout the entire loan term, is a change that many in the housing business have wanted for years. And now, cutting the life of loan policy is officially on the table, thanks to a newly introduced bill in Congress. The bill, entitled the Making FHA More Affordable Act, was introduced Thursday by Representative Maxine Waters, a Democrat from California, the ranking member on the House Financial Services Committee. The bill would repeal the life of loan requirement and reinstate the FHA's previous policy of requiring borrowers to pay mortgage insurance premiums until the outstanding principal balance reaches 78% of the original home value. The FHA changed its policy and instituted the life of loan policy back in 2013 as part of an effort to improve the health of the FHA's flagship fund, the Mutual Mortgage Insurance Fund. The FHA needed a $1.7 billion bailout in 2013 due to the significant shortage in the FHA's MMI fund. Since then, the fund turned in 4 years of growth, exceeding the congressionally mandated target in each of the last 2 fiscal years. And now, with the MMI fund on better footing, Waters is pushing for the elimination of the life of loan policy. According to Representative Waters, quote, families who take out home loans through the Federal Housing Administration should not be unnecessarily burdened with mortgage insurance premiums for the life of the loan, Waters said in a statement. My bill would remove this unfair requirement for FHA borrowers and help make mortgages more affordable for hardworking Americans, unquote. All right, so I am mostly excited about this, admittedly slightly nervous, not very much, but slightly nervous about this. And that's because we don't want to see the FHA back in a similar situation that it was in 2013, where their fund runs out of money because there are just too many foreclosures on these FHA-insured mortgages. Now, FHA loans have a higher delinquency rate and a higher foreclosure rate than any of the other loan types, conventional, VA, USDA. And that's because the FHA qualification guidelines are looser. For example, 580 credit score minimum for FHA instead of 620 for conventional and for USDA. Not just the credit score requirements, but also the debt-to-income ratio. I remember back when I was in lending, there were many occasions where I was able to get an automated approval on an FHA loan with a back-end DTI of above 50%. So I'm going to put up a graph here. This is from Mortgage Bankers Association. This shows the delinquency rate by loan type. Now, in order to be considered delinquent, you just have to be behind on at least one mortgage payment. So don't be alarmed by how high these percentages are. So, for example, right now, almost 11% of FHA loans are, quote, delinquent, which means they're behind on at least one payment. That can seem like a really high percentage, but the actual foreclosure rate is still less than half of 1%. But just look at the difference between FHA, which is the blue line here, compared to the other loan types, conventional, VA. So, of course, the truth is that FHA loans are a riskier proposition for the insurer than other loan types. That's because if you have looser underwriting requirements, if you make it easier to qualify, you've got an average pool of borrowers with lower credit scores, higher debt-to-income ratios. The natural result of that is you are going to see higher delinquency rates, higher foreclosure rates, which means that that fund has to kick in and insure those mortgages at a higher rate. All right, so to wrap things up, we've got a new segment called Ask Me Anything. This week we've got a question from John. John writes, quote, I'm really struggling to find a succinct way of explaining the new NAR rules. Whenever I'm at a listing appointment and the seller asks about it, I feel like I flounder a bit and don't feel super confident in how I address it. How do you explain the NAR settlement during a listing appointment, especially if the seller doesn't want to offer any buyer's agent commission? So that's a great question. I can assure you, you're certainly not alone there. We did a full episode explaining the terms of the NAR settlement back on episode 2. So you can find that at realestatebackstage.com/episode 2. We spent a lot of time going really deep into all the terms of the NAR settlement, particularly the practice changes that were implemented back in August that all realtors now have to follow. However, when you're talking to a seller, when you're explaining this to a client, you don't need to give them a 30-minute answer. The best way to do this is to keep it simple. So I've got a little script here, my recommended response that I'm going to put in the show notes. And again, you can find the show notes at realestatebackstage.com/episode 13. But I'm just going to read this here for you. I typed it up earlier today. So this is how I would respond. There are really two main changes that are relevant. First, we're no longer able to use the MLS to communicate offers of compensation being made to buyer's agents. And second, realtors have to have a written agreement in place signed by their buyer before touring any homes. So sellers can still make offers of compensation to buyer's agents, and I typically recommend doing so. We just can't include that offer in the MLS details. So because the vast majority of buyers use an agent when purchasing a home, offering to pay some or all of the buyer's agent commission is just one of the ways that we can help your property to compete against other listings that are on the market. It's no different than potentially offering to pay some or all of the buyer's other closing costs. If we don't offer anything and the buyer has to come out of pocket to pay their own agent, then that makes your home a more expensive option, and it will make it more likely that they will gravitate towards your competitors. If there's another comparable home for sale in your neighborhood and they are offering to pay the buyer's agent, that reduces their out-of-pocket costs and makes it more likely they will pick that home over yours. So you can choose to offer a specific amount up front, or we can kind of keep our cards close to our chest and wait until an offer is submitted and negotiate that along with any other term of the offer. Either way, you should expect there's a high likelihood that you'll need to pay a buyer's agent commission if you want your property to sell quickly and for top dollar. So one of the most common mistakes that I see agents make when they're explaining this to a seller about why they should consider offering compensation to a buyer's agent is they focus on, well, look how hard the buyer's agent is working. Buyer's agents put in a lot of effort, and it's not fair for them to not get paid. That is the wrong approach. When you're talking to a seller, you don't want to be explaining why this is of benefit to the buyer's agent. What you want to do is explain why it's in their best interest. Offering this will help your home sell for a higher price and in less time. That's it. Focus on why it might be in your seller's best interest and not why it's quote unquote unfair for the buyer's agents to do a lot of work but not get paid. All right, John, I hope that was helpful. And guys, if you have questions that you'd like me to answer on the podcast, you can send those in. Just shoot me an email at hello@realestatebackstage.com. All right, y'all, that's a wrap for the show today. Just a reminder, you can find the show notes with links to all of these articles at realestatebackstage.com/episode 13. And I'll see you here next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.